and welcome to Options Playbook, or I'm sorry, hello, and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook and your host for about the next 30 minutes here on the show. Today's date is Wednesday, April 24th. We have a slew of earnings coming out this week. A lot of the mega cap tech stocks are reporting. The one that we're going to look at today is Meta, and mainly because they're reporting after the close today. So we're going to look at a trade that's going to be relative to Meta's earnings based off of the fact that they're announcing on a Wednesday, and there's going to be all day Thursday, all day Friday to trade the option contracts after the announcement. We also on Monday went in and did a skip strike butterfly in the S&P 500 index. Our view, or my view on Monday, was that we're going to have a little bit more chop in the marketplace, and we were more neutral to bearish, but we did the skip strike butterfly just in case the market started coming back. Now, the market came back too fast. So for the first time in, since we started doing the weekly SPX trade, which was way back in November of last year, we have a situation in the skip strike butterfly where we're going to need to adjust it early. This is the first time it has happened. So we're going to look at that adjustment. So today, I'm actually going to start inside my website, optionsplaybook.com, and we're going to look at the potential adjustment and talk about it. Now, I want to emphasize that this is a very interactive platform. If you are in the Tradier YouTube channel, you'll see a chat box. If you put something in that chat box, I will address that question. You can also watch us inside the Tradier Hub, and we are streaming live for the first time on x.com. So we're expanding our range of opportunities to be able to watch Options Guide TV. So today is, I find it is a very interesting day in that we did a skip strike butterfly, and the market has moved more than one standard deviation since we put it on Monday. So, well, actually about one standard deviation to be more exact. And that has created an issue because it's gone too much so in the bullish direction for our butterfly too quickly. And as always, when we look at a skip strike butterfly, I build it this way on Monday, is that we're actually looking at it as an alternative to a short call spread. So I like to use, and I always have inside my book, the Options Playbook, and on the website, a lot of people will call this a modified butterfly, or they'll call it a broken wing butterfly. I like the skip strike because that's literally what you're doing in the strategy. And when you skip that strike, you're basically embedding a short call spread that pays for a standard butterfly. We went through a lot of detail on Monday's show, so I'm not going to go back through that detail again. I always do it whenever I talk about a skip strike butterfly. So if you want to go back and check it out, please feel free to look at the Monday archive of the show. Now, here's our strategy. Let's go to the Options Playbook, and we'll see here that we're right at strike A. So if we're setting up a skip strike, generally the stock will be at or below strike A. So in our case, especially with the SPX being a very a 5,000 point index, we're all the way down here. So this is the stock price. We would be all the way down here when we set this up. It says here it's at stock A or below. We are definitely below stock A. So the stock has came from this point over the last 2 days all the way up to strike A, and we're sitting right around there. Now, at expiration, this would be wonderful, but today is Wednesday and expiration is Friday. If it was Friday, we'd be sitting in the catbird seat and hoping that we would slowly drift towards strike B and be able to put the trade on for a net credit. In other words, we're buying the butterfly for a net credit when we initially put it on, and then also closing or unwinding the butterfly for a net credit to the account. So those would be That's a possible scenario when you're doing skip strike butterflies. But now we're worried about the fact that it's came up here too quickly. We can't necessarily, we don't have enough time decay to make this profitable between strike A and strike B. If we fly all the way through and we go basically little about a standard deviation and a half, not two standard deviations, about a standard deviation and a half, we're going to be right at strike C. And this is where our risk kicks in. This is where our short spread kicks in. And if we were in the short spread right now, we would probably be getting out of it. We'd be selling strike C, buying strike D. We'd still have a little bit of a range, but it would be hurting us to a point where we might want to just close out our trade or roll it out another week or do something to try to adjust the trade. We're going to look at a different adjustment. I decided I'm going to bring this adjustment into the fold, and I don't think I've ever done it on Options Guide TV. And so what I'm going to do is to try to manage this risk because we're down on this trade. The profit and loss graph as of right now, if I were to draw a tracer or if I had the tools that the analysts for the football games have, right, I would be able to draw all the way from here all the way down. This is about where the profit and loss graph is at on a Wednesday. On Friday, it's going to start drifting up this way and then coming back down. But as of right now, we're probably down, I don't know, $300 or so on the trade on our 1x2x1 butterfly. And we're going to get worse as we go lower. Maximum loss would be right down here at this level, which would be $1,000 at the expiration date. All right. So to hedge the position, and I would have done this yesterday when the market was obviously in an uptrend, but we taped the show on Wednesday. So we're going to take the screenshot or the skip strike butterfly that we set up, and we're going to sell a short spread below the market. A couple of days have passed, right? Monday, all day, or a half a day on Monday of trading, all day Tuesday on trading, and now about a half a day on Wednesday. And we're going to sell a short spread to try to bring in a lot of credit to offset the risk of the trade that we're losing on. And that way, if the market continues on up, the short spread will be profitable. And this will be a bullish or short put spread, wanting the market to go higher. And if the market does go higher, well, all right, that will help offset a little bit of our loss. But we'll still have a situation that if we really blow through strike B and start heading towards strike C, the skipped strike in our butterfly, then we're going to have to adjust the trade no matter what. We'll probably just end up closing it out. So to start with, we're going to do the short put spread to bring in a net credit to the account. That will not add any margin requirement because we're not adding additional risk because the market can't go up and down at the same time. But it will bring in a net credit, and it will also make the fact that if the market does swing back, now we have risk on the downside that we didn't have in the first place. So the other alternative, and I don't think I'm going to go there today because I don't think we're going to have enough time because we're also going to look at a meta trade today, is to do a broken wing or a skip strike. I said prefer skip strike with puts on the other side. Now, my issue is that the market has gone too much to the upside, and I don't think we're going to bring in enough credit. So you could end up with two skip strike butterflies. The risk is still going to be about the same because once again, the market can't go down and go up at the same time. And yesterday I might have done the skip strike butterfly with puts as an alternative. But now that the market has moved up, we're too far down on the position. We're going to need to bring in a decent amount of net credit to the account. So we're going to look at a short put spread. So let's zoom out a little bit from the options playbook, and we're going to run to the TradeHawk software and pull that up. Okay, so here's where we're at. We put this trade on for a net credit of about 70 cents. The markets were moving while we were doing it. We're now seeing the midpoint of this at a net credit of 280. So we're down about $2.10 on this trade as it is right now. So the market actually has came down a little bit. Yeah, all right. It was flat when I started looking at this about a half hour ago. And now I don't mind it as much here at the 50-60 level. So that does change things a little bit. So we're not down as much, but I still want to do the hedge because I'm still a little bit nervous and it's Wednesday. On Thursday, I mean, everything changes so much in the SPX. You get so much time decay from Wednesday to Thursday, and then you get even more time decay, obviously, from Thursday to Friday. So these 2 days are big as far as SPX option contracts are concerned, as far as time decay is concerned in the option contracts. Because, I mean, a 560 strike S&P option contract that has 2.5 days remaining until that expiration date is trading at $28. Like, just to show you how much time premium has to go away, that the 560 right now would be a worthless option on Friday on the close. So $29 worth of time premium would have to go away by Friday on the close because it's a 50-59 option contract to show that amount of decay that has to happen. All right. So here's what our trade is going to be. So inside the TradeHawk software, I do want to emphasize that I really love the way the chains are laid out. Highlight the most at the money option contract. On the left-hand side, we have the calls. On the right-hand side, we have the puts. We're looking to do a short put spread. And we also highlight where a 1 standard deviation move is at. So the dark area of the chains is within a 1 standard deviation move. If you go down to the gray area, then you are at a 1 standard deviation move, and the delta is going to be somewhere close to 16. That's just the way the math works. So if you want to look at, we can do a 10-point wide trade. So if we go 10 points wide on this, we're only going to bring in about $1 at the 1 standard deviation move. If we go here, little less than $2, we're down $2 on the trade. So right here, we're at a 20 delta, means a 20% chance that in 2 days that this option contract would be at least 1 cent in the money. That's if you ride it all the way to that expiration date. By the way, I should highlight the expiration date is April 26th, which is the same expiration of our skip strike butterfly. So I think we're going to stay right here, right at that 20 delta, leaving that probability fairly close to that. And we're going to go 10 points wide because that's our risk on the upside. And we're going to sell this option contract. So let me send this to the what if calculator. All right. And come back to the trading, and then I can clear this out. And we're going to sell the 20% chance of it reaching that level. And we're going to buy the 650. All right. So now we're bringing in a net credit of $1.50 to the account. If the market stays above 49.95, and 5,000 is a nice round number, so you got a little bit of protection here. I don't mind this trade just in general, but 49.95 is where we're at. 5,000 is a nice round number. It's going to be a little bit hard for the index to break through that, maybe. And then we're bringing in a net credit of $1.50. So that credit's going to come into our account. We're not going to have any more additional margin. Your brokerage firm might treat these positions differently. But as far as risk is concerned, you have 10 points of risk, or on your 1x2x1 butterfly, you have $1,000 of risk. On your short spread, you also have $1,000 of risk, but you're bringing in a net credit of $1.55 to the account, which is going to offset some of the loss that you have right now in your standard skip strike butterfly with calls, because that net credit can obviously work with you. But the market can't be up and down at the same time. It can't be up above 5,100, which is where our max risk is at on the call side of things, and also be below 49.85, where our max risk is on the put side of things. So we've just adjusted our strategy, brought in a net credit, and are offsetting some of our risks so we feel a little bit more comfortable. And bottom line is, now we have basically an iron condor on, something very similar to it. And if the market does stay within this range, and it just settles down for a few days, you could be profitable on both trades. That's still a potential on the trade. So if I go to the what if calculator, let's go in here and I've tried this before. It gets a little tricky in the options contract thing because it keeps putting in the SPX option contracts. I ran into this before. Oh, there we go. Roots. There we go. All right. So let's delete this and add this option contract. Okay. So let's go on the call side of things, and we're going to look at the expiration on the 26th. We're going to look at the strike of, what strike were we looking at? 49.95. 49.95. And I'm going to make this a put. Okay, so we're selling the 49.95. And then we're going to add another option contract. Make sure I got that right. Expiration, da da da. And then we're going to buy the 85. Add option. 26th. $49.85. Put. All right. There we go. -1 and buy one. All right, that looks right. Here we go. So I was able to pull that all off. So here is the final position. We have the skip strike butterfly on. Right now, our profit and loss graph is pretty ugly, right? It doesn't, without any time decay, we're just kind of hanging at this area, and it's done right now. This is based off of the prices as of now. But what I want to show is as expiration approaches, how this is going to change. So if we move one day ahead, the line gets closer and closer to what it looks like on expiration. That all moved up quite a bit. We're going to go again towards Friday, and this would be 11 o'clock on Friday that we would see this. And now let's go to 13:20 on Friday. And then all of a sudden, the profit and loss graph changes. Well, it didn't move. 13:20. And now we're starting to see it move a little bit more this way. So then 13, 14, let's go to 14:20. Let's go 15:20. Okay. 3 o'clock. And now this is the way the profit and loss graph looks. Now, this is assuming volatility stays the same. And so we see this area where we can make this max profit is from here to here. This area where we can get the max gain is as we approach. So basically by noon on Friday, we don't mind if it goes above our strike here, which is 50.70, and approaches the 50.80 level. And we brought in a net credit to the account. So if we stay within this range, within here, we have a bigger net credit. But if it comes down and it whiplashes on us and the market goes down to the 49.95, we're going to have to just get out on the put side. And that's the way that I would approach it. You would gain the benefit on this side of things of bringing in a net credit to the account, but I don't like to over adjust a trade. If I do this and I'm wrong, I'm like, all right, you guys win. You have too much volatility in the marketplace, and I get back to my short strike on this end, I'm just going to close that short put spread and just get out of the trade. and that simple. But now I'm giving myself, I'm feeling a little bit better about my trade. I put it on for 70 cents. It's now trading for about $2.90 to take it off, to unwind the trade. So I'm down a little bit on that trade. And if that is the case, I'm down a little bit on that trade. And now I brought in a net credit to try to offset some of the risk if the market does swing back up and start going towards our short strike of our butterfly, and it decides to do that too quickly. So here, let me even pull this down a little bit. I know the screen looks a little bit harder to see. I probably should pull that down to start with. And that's where we're at. So this would be our final position. We'd have our skip strike butterfly already established. We would be adding that short spread, and this is the way our profit and loss graph would look. All right, so if we go back to the trading, it's still trading at, well, it was 150. We'll call it 150. We'll call it 150. Okay, so 150 net credit. So our net credit then, 150 plus 70 cents is $2.20 net credit that we brought in on the entire position. We didn't add any more additional margin to the account. If the brokerage firm does the margin correctly, sometimes they don't recognize the two positions, but there's no more additional margin to the, as far as the risk is concerned, there's no more additional risk. So there really shouldn't be any more additional margin. And now we got another day. Let's see what happens. We're going to have a huge amount of earnings on Friday. So the market might be a little bit volatile from Thursday to Friday. We have Alphabet, Microsoft, Intel, all announcing earnings. Caterpillar announced this morning, and the stock is actually flat, which is kind of odd. But they announced earnings this morning, and let me see what else that we have. And then next week, then we continue with the FANGs or some of the Mag 7s. I don't know what you want to call it in this day and age, but we also have Amazon announcing next week on Thursday. Oh, Caterpillar's announcing tomorrow on the open. Intel is on the close. Alphabet is on the close, and Microsoft is on the close. Then you got ExxonMobil, which will be an interesting one too, considering what's going on in the energy space. They'll be announcing Friday morning. So a slew of top players in the marketplace are announcing on Thursday and on Friday. All right, so we're at time, but I want to do a meta trade, and the meta trade is going to be very simple because we have 2 full days of trading, and we got a $500 stock in meta. Stock is down today. I just want to get a little bit bullish on this, and all I'm going to do is use the 2-day option contract that expires on the 26th, that same expiration that we were trading in. And let's remove this, and here you go. This is the speculative. I don't want to deal with time premium. All I want to deal with is stock price trade. So we're going to straddle where meta is at. We're going to go equidistant in the money and out of the money. It would be nice if we're at 492.50, which we almost got there. We're bouncing around 27. So I'm going to buy this one and I'm going to sell this one. Boom. 5 points wide. I didn't mean to clap. Sorry about that. I got too excited about this. Every once in a while, that happens to be in option trading. But I am going to buy a 5-point wide long call spread and pay $240 for it. That means that if the market goes down, I can lose $240. If the market goes up after that announcement, I can make $260. 50-50 bet. If the market opens flat, I'm going to be just fine. I'm going to lose. It looks like it's 230 right now. Let's call it. If it was 492.30, I would be down 10 cents on the trade. It's 35 right now. So approximately. So even if the market didn't move at all, I've taken time premium out of the picture. And how do I know that? I'm going to look at the extrinsic value here. On this option contract, we're a couple of points in the money. It's trading for $21 of extrinsic value at the midpoint. This contract, it's trading at $20.75, midpoint right between these option contracts. That basically means you're down 25 cents. You're buying 25 cents more time than you're selling. If the market just stays where it's at and all the time decays, you're down 25 cents period on the trade. Total 50-50 bet. You're basically taking the one component out of the option contract that is hard to judge around earnings. You got implied volatility out of there, time decay out of there. Either the market goes up and you make 260, or the market goes down and you lose 240. You're not going to have a chance to adjust it. It's just going to be a fun trade. And if I just wanted to trade earnings and I just want to trade price movement, this is the way I like to do it. And you can go wider. You can add a little bit more risk, but it's a 100% speculative trade. So on Options Guide TV, I don't want to show a trade that's too expensive. If you're doing it on a one-by-one basis, that's that simple, that's straightforward. All right, that's it for this edition of Options Guide TV. Click the bell, or click subscribe and ring the bell. If you're on the Tradier YouTube platform, then you'll get all the alerts for the next edition of Options Guide TV. Hopefully, you're seeing me on X too, so you can stream that on X, and that's going to be the concept going forward. And then also check out the Tradier Hub. We have a plethora of good speakers inside the hub, and very simple, just one little sign-on, and you get into the hub and you see the display of all the top-notch speakers that Tradier has provided free of charge to you for anybody that wants to join. Thanks for coming. See you Friday. It's going to be an interesting Friday.
All opinions expressed by Tradier Hub contributors are solely the contributors' opinions and do not reflect the opinions of Tradier nor its affiliates and or subsidiaries. You should not treat any opinion expressed by Hub contributors as a specific inducement to make a particular investment or to follow a particular strategy, but only as an expression of their opinion. The contributors' opinions are based on their own personal research, but neither Tradier nor its affiliates and or subsidiaries warrants its completeness or accuracy, and it should not be relied upon as such. Any trades or positions discussed or referred to by contributors may or may not be actual live trades or positions. Such information is not intended to be financial or investment advice. Tradier Inc. is the parent company of Tradier Brokerage Inc. Tradier Brokerage Inc. and Tradier Inc. are separate entities with their own products and services. Securities products and services are offered through Tradier Brokerage Inc. Tradier Brokerage Inc. is an independent subsidiary of Tradier Inc., all rights reserved, member FINRA SIPC.